All right, welcome to Year-End Tax Planning under OBBBA. We will be talking through timely strategies for Christian business owners today. And we are going to start with a prayer and then kick things off with who's presenting today and more of the agenda items.
Awesome. Well, thanks, Rachel. Let me open us up and then we'll get started. Dear God, thank you for today. Just thank you for using us to share our expertise and use this time to hopefully educate and leave people better off than we found them as it relates to year-end tax planning and year-end business planning. Just remind us to use our voices for your kingdom and speak the truth and confidence that comes straight from you. Thankful for friends like Aaron, who are serving others in a very similar way to Rachel and myself, and just pray that you would use our influence to glorify you and speak your truth. In Jesus' name we pray. Amen.
Amen.
All right.
So we are sharing today about year-end planning strategies and tips to optimize tax position, hopefully save some dollars, but also to maximize our impact with the gifts and resources that we've been given. So before we get started, definitely want to share who is presenting on this webinar today. So myself, I am Rachel Dillon. I am the firm administrator at Dillon Business Advisors. I handle a lot of our initial conversations with prospective clients and prospective team members at DBA. Marcus, would you like to share a little bit about who you are and what you do?
Yeah. Yeah, Marcus Dillon. I'm the founder and president of Dillon Business Advisors. I am a CPA, technically trained, but great thing about us now is we've surrounded ourselves with a lot of great people who are more technical and better advisors than maybe even I am or others. Just the strength of a team is a very cool thing to see. And so I'm excited. Aaron, this is going to be your first webinar with us. So I definitely wanted to allow you a little bit of time to introduce yourself and share why your expertise is welcome today.
Yeah, thanks for having me on the webinar. My name is Aaron Noix, and I live in Denver, Colorado. And I'm the Director of Tax and Financial Planning at DBA. I'm a CPA and a certified financial planner, and I spend a lot of my time doing tax returns, but what I really love to do is to untangle complexities and help people find ways to save money and make smart business and financial decisions.
Awesome. Well,
I
yeah, and
think
that's needed in the world that we live in today because it seems like just things are getting more and more complex as we go throughout life.
Absolutely.
I think one other thing, Aaron, that you like to do, you have an extensive vocabulary, and I think you like to keep us on our toes and guessing if you're using actual words or made up words, and just make sure that we're always paying attention. I think I've had to Google or ask Chat more vocabulary since you've started with DBA than I have all the years prior. So appreciate that. You are definitely very wise and intelligent and have a large vocabulary. So if nothing else, maybe somebody will learn a new word today while we're talking through these things.
Yeah. I hope they learn a new word from Aaron versus a new word from me because it's definitely made up on my side.
I love it. All right, getting into the agenda. Here are the five things that we hope to cover today. We will do a quick overview of Dillon Business Advisors because this is actually our third webinar in the OBA, let me slow down. On the OBBBA webinar series, this is our third. So if you're not quite sure who we are yet, you can always go back and watch one of those. Or if you've missed that in the past, we would definitely recommend going back because those share a little bit different information than what we're sharing today. So after we share a little bit about DBA, we'll go into itemized deduction planning, business deductions, expiring credits that will be expiring in 2025, and then also some year-end to-do list tips and tricks and things to remember. So a lot on the agenda to get through. We would like to get through that as quickly as possible, but also to leave with as much helpful, practical information as possible as well.
Yeah. Yeah, and really, OBBA was signed into law on July 4th, 2025. It feels like a lot has happened since July 4th. Still unpacking some of it. We have clarity on some of the moving pieces. Obviously, Rachel, as you mentioned, like we want to lead people right before the end of the year to know what they can do, smart decisions before 12/31/2025, because some of the choices definitely need to be made in this calendar year to be impactful. So the goal of today's session is just to leave people more confident with their year-end planning decisions, and promote stewardship, sustainable growth, and intentional generosity. I've had a lot of those conversations with our clients over the last few weeks, leading up to kind of year-end final planning. So I think it is timely that we're releasing this and that it will be sent out to people to kind of take into account anything that does need to be done before year end. And then, as always, if there is any follow-up questions, we're here to support you. Just reach out and we'll go from there.
Yeah, absolutely.
All
All right.
right. So, yeah, DBA was actually founded in 2011. I think, am I the sole person that was here? So it's been a journey. I've seen a lot of different highs and growth, and that is the picture of the team. Most of the team, we have a few team members that aren't present there, and we've added a few team members after that picture was taken, actually just a couple of weeks ago in Houston, Texas, at our year-end DBA team retreat. So smaller team, but willing to go above and beyond to serve you like any larger firm could as well. So we are fully remote. We have office locations in Katy, Texas, and St. Louis, Missouri. But as Aaron even said, Colorado, we have a few team members there as well as other states. So we are a fully dispersed team, which allows us to hire great people without borders and, just serve clients really, really well without worrying about somebody being physically present in an office every day. So, our main goal at DBA is really to elevate others and to make sure that we're being good stewards of the resources that we have, both the team, the time, the talents that we have in our possession. The way that we do that on a daily basis is with business and tax strategy, practical advice baked into everything we do. We have plans that revolve around monthly accounting and bookkeeping, make sure that the monthly accounting and kind of the ongoing maintenance of the business is being captured timely and that it's relevant. That way, business owners and financial decisions can be made timely. The second part of that is advisory meetings. We can structure those to where they either occur quarterly, which is what most people prefer, because quarterly we can look at trends in the business, make decisions based on those trends, and pull certain levers before either year end or things are more than necessary to be changed. And but we can scale that whether it's an annual touch point or monthly touch point. We can scale with the business needs as much as possible. The other thing we do is semi-annual tax projections. We love to make people aware of where their business is at and what the tax implications of those business results are. So that's where a lot of my conversations here the last few weeks have been spent on the other side of tax projections. Clients who've had really successful 2025 results and are surprised by the tax implications of those results and wanting to know what are the smart decisions that can be made before year end. So obviously that leads into a lot of what we'll be talking about today. And then that final point that's baked into all of our plans is just that annual tax compliance. A lot of our tax returns and preparation of those returns are done really just as a byproduct of all the advice and all the work that we do throughout the year. We try to fully serve a client where they're not surprised by a tax return result. And so the only way that we can do that is by all the other points, all the other advice and the team that's supporting that goal. And then with everything we do, our main goal is impact at DBA. And so, Rachel, I'll let you explain what the impact acronym means to us and our team here and how it applies to the people we serve.
Yeah, so for us, impact stands for integrity, meaningful work, people first, appreciation, collaboration, and transparency. So those are our core values that spell out impact because our main goal is to really impact small businesses, the communities that they are in and serve the families within those small businesses, and then also our accounting industry as a whole. And so the things that we do, the decisions that we make, the services we provide, and advice we give all line up to make a positive impact with all of the people that we interact with on a daily basis. I love that you mentioned also the semi-annual tax projections because that really is what prompted this webinar and sharing this information. The conversations that you and Aaron and all of our client controllers are having with clients. We didn't want to reserve those for those one-on-one conversations, but really wanted to share that advice that's being given in that one-on-one setting with as many people as would be able to take that in through a webinar. So this kind of helps us disseminate that information and multiply that impact really with just, again, the resources that we currently have available to us.
Yeah. And you mentioned kind of the accounting industry and our peers. So we know that some fellow accountants, some other firms will likely be watching this as well. And so that's awesome. That's part of why we exist as well, to impact our friends that are also running very similar businesses, impacting very similar clients and families and communities. So welcome to all of those that may be watching this that own a firm or just looking for additional tips to give their clients. We truly count that a blessing to be able to serve our friends and give them, just additional insight where we're thinking and share our team with them. And so that's exciting with Aaron joining the team in 2025. We've also done that with Angel, our director of technology, who joined the team in 2025, as well as Amy McCarty, who joined the team officially a couple years back. So being able to share and elevate others, especially other accounting firms, and doing that in very special ways, count that a blessing. So definitely want to jump in. I know that we covered a little bit of DBA. If you have any questions about DBA, as Rachel mentioned, she is the best point person to have some of those initial conversations. She's much easier to talk to about DBA and loves to share about our team and how we serve others. But really just wanted to get into, some of the topics for today and why year-end planning matters.
All right, Aaron, you're up. Will you share with us some of the reasons that you think year-end planning matters? You can expand on that even if you've seen how, that's impacted clients positively.
Sure. This year in particular is one of the most important year ends in terms of tax planning. And it's primarily because of the unsurprisingly ostentatiously named One Big Beautiful Bill Act, the OBBA. And what's interesting about OBBA is that it will impact virtually every taxpayer in some way. It's so far-reaching and changes the landscape so much that even the smallest of returns and the largest of returns are gonna feel some impact from it. Um, about the time that Elon Musk was kind of ending his bromance with Trump, he was interviewed and he said that he said a tax bill can be big and a tax bill can be beautiful, but it probably can't be both big and beautiful. And so there's some wisdom in that as we approach this bill because there with any bill that's this big, there are going to be significant winners and losers. And probably for everybody within your own return, you're going to see some areas where you save money and some areas where you're paying more tax. What's unique about this bill, though, is the way that it changes the landscape is it also creates a lot of planning opportunities. So if you're thinking ahead on things and you're doing your projections and working with your advisors, you should be able to make some changes and to move some things and make some elections so that you can take advantage of the opportunities that are created.
Yeah, and I love the fact that, as part of this bill, it made a lot of things permanent, quote unquote. And so permanent just means until maybe somebody else changes it. So we actually can do multi-year planning, which is really special because we were in this season for the last, I would say, couple of decades where it was always trying to get things done before tax laws or rates or credits expired. And so what this does is it actually gives a little bit of clarity there. We always have to give an asterisk that permanent can be changed at any time. within the tax code as we've seen before. But at least we know the tax rates, at least we know some of the exemptions and things that will be multi-year, multi-generational impact, if you will. And the other thing, to your point, like the planning, there's been a lot of discussion on that, and there's some easy, low-hanging fruit that can be done today. That's where we'll probably spend a lot of our time. But then there's also some very technical, generational, multi-entity planning that could be done. But even some of that, as we've discussed, Aaron, some additional clarity may be needed from the IRS and different lawmakers on if that was truly their intention with this bill before we really advise clients to go set up five different trusts to take full extent of the exemptions and deductions given this first pass and what could happen. Some additional clarity may need to come before we really dive into some of the deeper planning.
All
All
right.
right,
And
Angel.
I think the main point here, Aaron, I love that you shared it's not too late to implement tax strategies now, and it's never too early to prepare for the following year. So just something to remember if you feel like, oh, it's too late, I don't have time. You probably have time all the way up until 12/31. And if you miss that deadline, then it's never too early to start preparing for the following year. So, um, with that, we'll move into itemized deduction planning.
Yeah, and so this was a big part of it. This is some of the changes that could surprise people. OBBA was celebrated in most circles as far as big wins for the taxpayer, especially some of those high net worth taxpayers. But when it comes to itemized deductions, there's actually some not so favorable treatments that we need to point out for 2026. So, Aaron, I'll flip it to you, just giving some of the basics on this itemized deduction planning that can be done.
Sure. First, just for background, taxpayers have a choice. They can either take the standard deduction, which is a little over 15,000 for singles or 31,000 for marrieds, or they can add up a basket of what we call itemized deductions. So those would include things like medical costs, state and local taxes, mortgage interest, investment interest, and charitable donations. And each of those different categories will have various limitations, some of which we'll talk about in a minute. But when you add all of those up, if they're higher than the standard deduction, then you get to take the sum of those itemized deductions. Otherwise, if you don't have a lot of those itemized deductions, then you just take the standard deduction.
And that's part of really the analysis that we've done over the years, and any good tax software, tax advisor would do as well, is optimizing your whole picture, choosing standard or itemized deductions. Because over the past, there's been even AMT tax and things like that that would factor in to where you really need to look at the whole picture. Maybe married filing separate is also a very real thing in a certain family situation. So love the fact that people do have a choice, and then also that good advisors help optimize the choice for the client. All right, well, looking at one of those deductions that you already mentioned was the state and local tax. It's referred to as SALT in a lot of circles that we're in. So, but state and local tax, there were some changes. There potentially are some benefits. So, thinking about SALT and how it relates to, business owners and individuals, let's talk about that and unpack that a little bit.
Yeah, so this is one of the big changes in OBBA. Previously, taxpayers were limited to only $10,000 of state and local taxes, which can include income or sales taxes, your real estate property taxes, even on second homes, and in some states, your auto registration renewals all combine into that category. So we were limited to just $10,000 per tax return. And under OBBA, they've increased that to $40,000. Now, that's a significant increase, and a lot of people with higher incomes look at that and think they're going to get a $30,000 additional deduction. However, there's a phase out. If your income is over $500,000, then that $40,000 limit begins to phase down back to the $10,000 limit. So if you make $500,000 a year, you'll get the full $40,000 deduction. If you make $600,000 a year, you're completely phased back down to the $10,000 deduction. So what that means for people is it, first, for a lot of people who didn't itemize in the past, this may allow them to start itemizing. So that means you're probably going to have to collect more information that you may not have paid attention to. Some of your small charitable deductions or your auto registration renewals, because your tax preparer is going to need all that information. Um, this is particularly beneficial for taxpayers in high tax states. So you think about places like New York and California, but even a place like Illinois, where the income tax is moderate, the property taxes are quite high. So it's a particular benefit for some of those higher tax states. The other interesting quirk here is that there's a pretty significant marriage penalty. So you could imagine a couple where each person made $300,000. And prior to this law change, they would each benefit $40,000 of state and local tax deductions on their individual returns. But as soon as they get married, now their 300,000 plus 300,000 gives them a total combined income of 600,000, and they would be phased down to only a $10,000 deduction. So you're going from potentially 80,000 down to 10,000 just for having gotten married. So that's a planning point for anybody that's going to a wedding, maybe a holiday wedding. The best gift you could give them is to tell them not to sign the paperwork until after New Year's.
Yeah, get one more year of deduction. And, obviously, hopefully the audience, marriage is a bigger conversation than just tax planning. But if you are attending a wedding, I love that last piece of advice.
Yeah, the best gift they'll get for sure.
Yeah, that's good. And Rachel and I, we actually ran the numbers on this. If you want to go back, yeah, the this applies to majority of DBA's clients. We saw that majority of DBA clients would benefit under this new tax change. And with, I remember when the $10,000 cap went into practice, and a lot of us started phasing out of property tax. And even though Texas doesn't have state income tax, we do have higher than normal state property tax. And sales tax and things like that are phased out for a lot of people. So we saw a majority of DBA clients spread out across the nation who are going to benefit from this. And then that last column is really important because if we do have clients that do phase out, then there's still some planning that could be done for the most part to get them below those phase out ranges, especially if they own a business and we can do business level planning to make sure that we are optimizing that potential $30,000 benefit. All right. Sorry to slow us down, but I just wanted to add
No,
a point.
no, that's perfect. Um, I think that that's important, right? Is that making sure people understand, does this even apply to me? And not tuning out that, it doesn't apply to me. It does apply to a lot of people. So making sure that you understand which side you're on and what is the appropriate response to that.
Well, and I think the other piece there, we talked about timing of payments. Prior to the $10,000 cap, we used to have people double up property taxes in any one year and then flip to standard deduction in the following year and kind of do that. That planning could be back. And so would really recommend people talking to their DBA advisor, or if they're not a DBA client, to their own advisor and seeing if it does make sense to double up in any one calendar year those property tax payments, or if it still makes sense to pay those evenly each calendar year.
All right, on to the next.
So
Now we're getting into some negative parts, right?
that's right, yes. So the second itemized deduction item that OBBBA changes that we want to highlight is related to charitable contributions. And there's two changes that are kind of two sides of the coin. On one side, beginning in 2026, 0.5% of your income will create a floor that eliminates charitable deductions. So, for example, if your income is $100,000, 0.05% of that is $500. The first $500 that you donate gets wiped away and you don't get any credit for it. Now, the other side of that coin is they've created a special deduction for non-itemizers. So if you don't itemize, you're now able to deduct, in addition to the standard deduction, you're now able to deduct $1,000 of donations for single filers or $2,000 for married filers. And so again, neither of these changes affects 2025. These both come into effect in 2026. So when we think about a planning response, if you're someone who doesn't itemize, then it's probably beneficial for you to wait and not make that donation in the next few weeks, and instead wait and make that deduction in 2026 when you might get a benefit for it. Now, on the other side, if you're a higher income taxpayer and you have a lot of donations, you're very generous, it probably makes sense for you to think about accelerating those deductions into 2025 so you can avoid that 0.5% floor and some other things in the bill that we're getting ready to talk about that will make your itemized deductions more valuable in 2025 than they would be if you waited until 2026.
Yeah. No, this is really good information to equip people with before year end. I think the fact that it's got to be a cash donation for those people that take the standard deduction, that doesn't apply to the non-cash goodwill drop-offs. You can still do those, and that benefit won't change. But it's really those cash donations. Maybe looking at those for 2026, and we're coming straight off of Giving Tuesday, and a lot of push from charities that we love to kind of get some different monies in and before year end, and there was different campaigns to where those would be matched or doubled. So that was really cool to see. Obviously, we don't let the tax implications drive our charitable generosity, given our values and belief system, but definitely want to leave people a little bit more educated. And there are, Rachel and I hosted a webinar previously with our friend Trey Little at National Christian Foundation. There are other vehicles like donor advice funds that help maybe bunch some of those charitable contributions into 2025. So there's a very real place for donor advice funds in 2025 to accelerate and bunch those donations that you could use in future years. So love the fact that there are options and things to think through before just accepting. I think one of the biggest negative impacts that came out of OBBBA, because we are so generous as far as a family base of clients.
All right.
So the third item with itemized deductions that we wanted to highlight is a special limitation, and this will only affect very high income taxpayers. So for taxpayers that are in the highest tax bracket, the 37% tax bracket, and those would be incomes above around 640,000 for single or about 768,000 for marrieds, the benefit of your itemized deductions is going to be limited to only 35%. So when you look at your deductions covering your income or offsetting your income, there's going to be a 2% friction where deductions for those higher income taxpayers are only going to benefit at 35% and won't quite cover the full amount of income offset. So what that means is again, for higher income taxpayers, particularly taxpayers that are more generous, because donations is one of the variables that we have the most control over, particularly with timing, that it may make sense for those taxpayers that are affected by this to accelerate their charitable deductions into 2025. Because if you wait to 2026, in addition to the charitable deduction limitations we just talked about, you'll also lose about 2% of the benefit.
So just piling it on with the negatives, right, as it relates to itemized deductions. I think the thing to point out here, Aaron, is the brackets, the 37% federal tax bracket, which is the highest rate, and that's been made permanent now. Those dollar amounts, the 646 and the 768.7, those are actually those change or go up just a little bit in line with inflation. overall, but that's going to be taxable income. So whenever you hear someone talk about income, they may throw it out. They may think that that's like their gross income, like their W-2s, their interest, their dividends. Taxable income is different than your adjusted gross income. So your adjusted gross income is the total of all of those income sources added up, and then your taxable income deducts your itemized deductions, correct? And then so that then you arrive at your taxable income of that number. And if you're above those two numbers, that's 640, 600, 768, 7. If you're married, then you're pushed into that 37% tax bracket. And what the benefit, I guess, the government gets of you going into that bracket is they're only allowing your itemized deductions to have a benefit of 35%. So a little bit of a penalty there for going into the highest tax bracket.
All right, you guys are doing an excellent job giving examples as we go along, but we'll look at another example on this next slide.
Yeah. And so this was one that we actually shared in a previous webinar whenever OBBA, we were just starting to unpack it. And Aaron actually reviewed this and blessed it and said, hey, this is still good. Y'all did good work when it was just the two of us. So this is a very good example to look at. Obviously, you've got somebody that's got AGI of $1 million. So they're going to be in that highest tax bracket. 2025 compared to 2026, we just want to show what the value of that $100,000 charitable donation would be in 2025 versus 2026. And I think using very round numbers in a very real situation actually shows that, hey, the benefit of that $100,000 deduction in 2025 is easy. It's 37% times 100,000. You're going to get a tax benefit of $37,000 this year. It's pretty easy to calculate. Then you go into the OBBA changes in 2026, and you introduce now the contribution floor, that point 0.5 that came into play in 2026, and then also the itemized deduction limitation, getting you into that 35% benefit cap. And with those two things, it's about a $10,000 reduction in the benefit of that charitable deduction, which from a tax perspective, that lowers the benefit by about $4,000 in year over year. So hopefully I explained that clearly, Rachel. I know you always do a good job of making sure that I speak clearly. So any other questions about that, or was that fairly easy to understand?
Yeah, I think fairly easy for me to understand. Aaron, anything extra to add that might give some more color to that for anybody watching?
No, I think that about sums it up. You can kind of, because those are nice round numbers, you can sort of adjust those numbers to where you are, where your contribution, your income level is, to kind of see how that might impact your own tax return.
Yeah. And there's plenty of other planning that, our advisors do to make sure that that top line number, that $1 million in that example, is as low as it possibly can go. And now we'll get into some of those opportunities and what those changes could actually look like if you have a business, because doing your tax planning at the business level as a business owner is definitely the first place to start. And we're going to get a lot of benefit from tax planning.
Absolutely. I talk with a lot of our business owner clients and even before they become clients of DBA. And this is the number one thing most business owners want help with, is really what deductions are available. And most often said as, what am I missing? I know I'm missing things. I need someone to tell me what I'm missing. And that is really our job. And one of our value propositions is to really help people think through what are all of the opportunities that coordinate and help accelerate their long-term goals, not just how many dollars and cents can we save this year, but really make sure that those line up with goals long term. So we'll talk through some business deduction changes with the new tax law.
Yeah, and just like with the itemized deductions, we'll take a big benefit and then we'll actually show something that may not be as beneficial under the new tax law. So, with our clients that are working with us throughout the year, obviously asset acquisition and depreciation comes up quite a bit. The timing of those purchases And so having accelerated depreciation back, and I think it's permanent, correct, Aaron? It wasn't under OBBA. Some of this is now permanent in quotes.
More of it is, yes.
Yeah, so it's always good to see it coming back because then we can plan out those purchases better versus going into debt or using all of the cash flow in a certain year to go out and buy assets just to get depreciation and then looking up next year and having to maybe do that same thing to avoid some of the taxes that could be a burden on the business. So, but looking at accelerated depreciation and just the law changes, Aaron, what's the highlights to take away?
So what's nice about depreciation is there are a variety of elections that we can make where we can almost exactly pinpoint the amount of depreciation that you're going to recognize in a year so that we can avoid some of these income phase outs and negative consequences we just talked about. The first change with OBA is the 100% bonus depreciation. So this is for equipment, furniture, fixed assets. And if you purchase it after January 19th, you can now deduct the entire purchase price all in the first year. Before OBA, that was phased down to only 40% of the purchase and was scheduled to go to 20% and then eventually to zero. So this allows us to significantly speed up the amount of deductions and hopefully match the cash that you've paid with the deductions and reduce your tax burden when cash flow might be tight. Another election we have is Section 179 in the tax code. And this allows us to take anything that isn't covered by bonus depreciation or any assets that don't qualify for bonus depreciation. And we can elect up to $2.5 million in any amount that we want that we can take in the first year of purchase. Now, that does begin to phase out around 4 million of total purchases and is completely phased out at about 6.5 million. So as businesses get bigger and the acquisitions get bigger, this may not be a tool that we can use, but certainly for smaller businesses, it's something that we can take advantage of. And then they created a new category for production property. So typically real estate is depreciated or the deduction is recognized over 39 years, which is a long time. If the property qualifies as production property, which could be manufacturing or agriculture, there are certain industries and requirements. But if you meet those, you can deduct 100% of the new building construction. And in some limited cases, you can even buy an existing building and recognize 100% all in the first year, which we've never had before. So when we think about the impact that this has, and particularly the planning responses, if you want to take advantage of this, you need to make sure that the asset is actually put into service before the end of the year. So you can't just pay for it or order it or even have it delivered before you go to your New Year's party. Stop by the office and flip on the big piece of machinery so you can make sure and take all those deductions in 2025. But it's also important to consider multi-year tax projections. If you buy a lot of equipment in one year and you recognize all of the deductions that you can potentially eliminate all of your taxes. But what can happen is that you start by eliminating some of the high tax rates, but as you get down to having zero taxable income, you're actually eliminating tax at a very low rate. So in some instances, we may actually take our foot off the gas and not take advantage of all of these because we may want to save some of those depreciation deductions for future years when we can offset income at much, much higher rates. So projections under OBA are more important than they've ever been. And then the last point I'll make is if you're buying a new building or doing new construction, you may want to think about a cost segregation study. If the everything is just considered a building, it's spread out over 39 years. But if you can take portions of that building and call them equipment or other types of property that might qualify for the bonus depreciation or the 179 deduction, we can peel those out of the 39% bucket and take some of those deductions much faster.
Yeah, I love that we've got additional guidance and more benefit than previous years. I think bonus depreciation, that being back is a very good thing. And even in certain situations, bonus depreciation allows you to go into a loss position and allows you to offset other sources of income. Maybe there's high income from a particular event that you're trying to offset. So we'll see clients wanting to pair up purchases and investments to offset some of that, which makes a lot of sense. We've also, I think it's funny that it starts on assets acquired after January 19th. For those of people that may not be in tune to that date, that's when inauguration happened and whenever President Trump was officially the president after that day. So the first 18 months of the or first 18 days of the year, you don't get that benefit. It was only after inauguration. So politicians just being political. You gotta love it. And then something else, the purchasing of, let's say, a building, the reason all tax law is it's the government subsidizing and wanting you to do things that benefit what their intentions are, right? So some of these changes are definitely to promote overall incentives to bring back things like manufacturing to the United States. So obviously, the qualifying production real estate, that's to bring back manufacturing jobs and locations here in the States versus using other countries to do that. And that was a big push under this current administration. And so here's the benefit to bringing back some of those facilities and those jobs to the States. One side note is a lot of people think that whatever you buy could qualify for depreciation, and most likely there's going to be a land component to an acquisition of real estate. So, and land cannot be depreciated. They didn't change the tax law to allow for depreciation of land. So that's why a cost segregation study is still really beneficial to make sure that the total purchase price of that real estate asset is allocated appropriately based on market value, that it would pass the smell test with the IRS. And then if you are qualifying for some of these even expanded 100% depreciation on production real estate, that cost segregation study is also going to help determine that you are allowed to take that additional bonus that's now available to those type of facilities.
All right, moving on to the next item.
So now for the bad news with the business deductions. Meals and entertainment is a difficult area to untangle because there are multiple code sections involved in multiple categories. But there's one particular category that actually in the 2018 tax law was scheduled to expire at the end of 2025. And OBBBA did not extend that like so many of the other provisions. So this particular category that we want to highlight is they refer to it as meals for the convenience of the employer. And what that basically means is that if your employees, if it's beneficial for the business that your employees stay on the job. So as CPAs, we might work long hours during tax season. You can think about meals while we're working late, but it could also apply to maybe your IT guy who has to be on site to deal with emergencies or people who are on call to deal with customer situations 24 hours a day. If they eat meals on site, those meals used to be deductible at 50%, and now they're no longer going to be deductible. There are some exceptions for certain industries, particularly for restaurants. If you sell food as part of your business, then you're still able to maintain this where you can provide those meals for your employees and deduct it. And then as a reminder, none of these changes affects meals with travel or meals with customers and other contacts. Those are all still deductible at 50%. And company social events that are open to everyone, that are supposed to promote everybody getting together and recreation, those are 100% deductible. That's something that a lot of people end up missing. So when we look at what our planning response is, you may want to look at your accounting system. A lot of people will just put meals and entertainment into one big bucket. And typically, your tax preparer might just assume that those are 50% meals. And this year, or at least in 2026, if your tax preparer assumes that those are all meals for the convenience of the employer, they may not deduct any of them. And it could be that you've got social events or travel or other meals in there that are deductible. The other thing to think about is to really look at the purpose of the meal. So maybe you have a meal for a meeting. If you're able to open that meal up to everybody, then you can call it a social event, and then it becomes 100% deductible. So it's time to sharpen the pencil and take a look at what's really happening at these meals and making sure they're getting categorized correctly so you can at least get some of the benefit.
Yeah, that's really good. And over my career, we've seen changes to meals and entertainment a few different times. And we saw recently where entertainment goes from 50% deductible to zero, no deduction at all for those. And that's when we saw that wave of season tickets and different events lose the benefit at the business level. And so maybe some of those went to the personal, or maybe they just went away altogether, or you're just not getting a tax deduction for some of those type of entertainment events. So that was the first wave. And then with COVID, we saw there was a benefit and a temporary add back to make things 100% deductible. That was to promote people getting out there and going back to restaurants and doing things like that. But that ended as well. And now we kind of have this, which is coming into play where we would see clients in the healthcare industry really always have food provided at lunch to make it easy for their clinical staff not to have to leave or bring their own lunch. So that was a very real thing. And now the flip side of that is that's likely not deductible unless something else changes, as you mentioned, Aaron. So would highly recommend reviewing your chart of accounts in your general ledger program and QuickBooks if you use that. I know that our team at DBA is already preparing for some of those changes for 2026. But if you take point on that yourself and do your own accounting, definitely, as Aaron mentioned, it would be a benefit to break out things into the right categories so you can maximize what you do get credit for. And then also just rethinking, hey, how can we open this up to everybody versus keeping it a little bit more closed? Do we need to bring in certain clients or certain referral partners to really have this be treated a little bit differently? And I think that's all helpful advice as we get into 2026 and lose deductibility of those meals that we have been getting benefit of.
All right, we'll keep moving along with some expiring credits. So some things that we may have taken advantage of in years prior that will be expiring coming soon.
Yeah, and this is, we're hitting on a lot of negatives from OBBA today, which is unusual for some of the webinars that I've been a part of or even watched here recently. Everybody's touting the good things, but we want to definitely show both sides. And, with the current administration, some of the green initiatives, some of the different things that were promoted over previous administrations, they chose not to really extend. So, Aaron, I'm going to let you kind of dive into some of the law changes on the energy efficient credits.
Yeah, there's three different categories that we want to highlight. First of all, the electric vehicle auto credits have already expired, so you're probably not going to get a Tesla for Christmas this year, or at least my wife isn't. Then the second category is there are a collection of small energy efficient home improvements, some HVAC, insulation, windows, water heaters. And each of those improvements has pretty small credits, a few $100s, maybe 1,000 or $2,000. Those credits all expire at the end of 2025. So if you have something that needs to get done, you have a project that's in the works, you want to try to get that done before the end of 2025, and some of that cost can be offset. The real important one is for people who are in the middle of solar or geothermal projects, or maybe building a new house that's going to have solar or geothermal heating and cooling systems. It's a very large credit. It's 30% of the cost, and there's no limit on it. So for some of these larger projects, this is a really significant dollar amount. And those credits also expire December 31st of 2025. And for those larger projects, the project actually has to be finished and the system actually put into use by the end of the year. And if you're building a new house, you have to actually move into the house in order for that to qualify. So just because the solar project is on, and just because it works and is operational doesn't mean you'll get the credit unless you've actually moved into the house.
Yeah, it's
And
really
then
good.
the third last thing I'll mention is that some of the tax reporting does require that we get certain serial numbers and codes from some of the paperwork. So if you have one of these projects from 2025, make sure you keep that information because your tax preparer may be asking for it.
Yeah. And I feel like, and this mainly relates to residential primary residence, as it has in years past. This is not business property and deductibility of improvements at the business level, which may be capitalized and depreciated. This particularly is aimed at residential primary improvements, correct, Aaron?
Correct. Yep, it is. There are some business related credits. Most of those relate to really significant construction projects, and those are expiring as well at the end of 2025.
Okay. And if you've been involved in some of these green initiatives and actually bought some of them, the way that the sales process works is they would typically show the credit as a subsidy of purchase and lower your cost to be more of a net cost that included these credits. So if you were sold something in 2025 that Aaron mentioned, you definitely want to make sure that that is put into service and potentially move into your house if that's an option to make sure that you do get that benefit that you were sold for that product. And obviously in 2026, those subsidies go away. And if you're evaluating some of these different improvements to your personal residence, you would really look at the cost benefit over time and that subsidy that you could have received in the past actually goes away. So I think from a sales perspective, it makes it a little bit cleaner because the EV companies, the solar salesmen, they would always show kind of your net cost as part of their sales pitch. So I think it hopefully will lead to a better buying decision for people. But definitely it stings a little if you believe in this and chose to partake in some of these improvements that the credits or the subsidies are no longer there.
So the next expiration that we want to highlight is related to the Affordable Care Act, or what some people refer to as Obamacare. When they put this law into place, it created a marketplace exchange. So this is for people who don't get health insurance from their employer. You can still go out and get health insurance from a company, or you can go to this exchange. But what makes the exchange special is it's the only on an exchange plan can you receive the subsidies. And for some people, these subsidies are substantial. When we went through COVID, they made a couple of changes that significantly enhanced the subsidies for middle income taxpayers. And there's two that we want to highlight because they're expiring at the end of 2025. So when you're shopping for plans for 2026, and for most states, when in order to have coverage start January 1 of 2026, you need to have the plan in place December 15th. So if you haven't done that yet, for most people, this will be in the next couple of weeks. And unfortunately, some people may have some sticker shock, partly because the plans themselves are more expensive because of the rising cost of healthcare, but also you may get some sticker shock because these subsidies are changing. So the first one is the original Obamacare had a cliff where if your income was more than 400% of the poverty level, and for 2026, that's around $62,000 if you're single and $128,000 for a family of four. If you're in excess of that 400% level, even if you're in excess by just $1, you lose the entire subsidy. And the second thing is they added a cap to say that if your premiums were more on a reasonably priced kind of mid-level plan, if your premiums were more than 8.5% of your income, then they would cap it and not have the premiums be any higher than that. Both of those two provisions are expiring at the end of 25. So from a planning perspective, there's a couple things that we want to think about. The first one is you really need to look at these plans right away because there may be significant sticker shock. The second thing is that if your income is really close to this 400% of poverty level cliff, you really need to try to manage to get it down. I've had clients that where we've made an IRA contribution of a couple $1,000s to get their income below the 400% cliff, and they've been eligible then for a subsidy of 14 or $15,000, where if we hadn't been paying attention, they would have lost that entire subsidy. The other thing to note is when you first sign up for these plans, you tell the marketplace what your expected income is. And then when you file your tax return, if your income turns out to be higher or lower than that, they will adjust the difference on your tax bill. And so if your income changes in the middle of the year, it's important to let your tax advisor know, and it's important to let the marketplace know so they can adjust your premiums so you don't get an ugly surprise when you go to file your tax return and you find out that you owe significantly more than you expected. The other thing is that there was a trend because of these enhancements where some employers who employ a lot of lower and middle income people, where they have decided not to offer company health insurance because they felt like it was better just to give their employees more money and then they're able to take advantage of these significant subsidies. But going forward, now that those subsidies may be falling off for middle income taxpayers, you may need to add a plan or address this with your employees to make sure you're staying competitive because they may consider changing jobs if it means an $8,000 or a $10,000 subsidy has disappeared.
Yeah, those are all really good points. And healthcare, it's one of those costs that just seems to continue to rise. And the fact that the subsidies are going away is it will be shocking to some that are getting the subsidies. And as you pointed out, we've had clients where maybe they were in a transition, they left their employer and they're starting a business, so they had low income for a little bit of a season. They qualified for these subsidies through the marketplace, but then their income returned and they started to be doing better in the business and overall. And when they owed that subsidy back with their tax return, it was hard to explain and for them to grasp because those are dollars that offset the premiums and you're repaying that subsidy in those scenarios. So yeah, it's never a fun conversation for us as the advisor. So definitely communication of changes is highly recommended, so there aren't those surprises. And to your point, I think it is time, where if employers are looking at group health and some of those changes, making sure that that's assessed, or it could impact your workforce, as you mentioned. So people do go seek out those benefits from other employers.
And a lot of small business owners will share how difficult or how expensive it is to provide healthcare to team members. But as we know now, how difficult and expensive it is to hire and find and procure new team members, that if you like the people that are working with you on your team, it is important to take this into consideration and make sure that it's communicated because this directly impacts people. And anytime that it is a direct impact to that person, that will definitely prompt a change if there was any type of, idea or a better opportunity that is available for them to take.
Yeah, for sure. And I think we have a good example of just somebody that was receiving a subsidy. So a 50-year-old couple, $100,000 of income, they were actually getting that 8.5% cap coming into play. So they were only paying that maximum there. And then that's 2025. So if we look at 2026 and the changes that could come, those subsidies go away. And it actually could be shocking, right? It could be up to $15,000 with those additional plans in 2026, whenever we look at those subsidies going away once they pass that 400% or that $84,600 level. So capped at 8,500, not capped, going to cost around 15,000. That's not fun whenever that additional 800 to $1,000 a month expense comes out of the family budget. All right, so we've talked about a little bit of good stuff. I feel like we've harped on a lot of negative this webinar. So But in order to avoid those negatives, I think we want to leave people better off than we found them, and just let them know what they can do before year end as far as managing income limits and phase outs.
So we've got 5 ideas here, and these would all be things if you're worried about those various phase out levels. These are all ways that you can decrease that income level and hopefully avoid some of those pitfalls. One thing you can do is you can max out your retirement plans or your employee benefit plans, IRAs, 401ks. If you're self-employed, there are a lot of options for SEPs and solo 401ks. If you have a health plan that qualifies for health savings accounts, an HSA is another way you can do that. For those that take required minimum distributions, so at age 73, you're required to start taking money out of your IRAs. And if you're in that age group and you have an IRA, one option is instead of taking that in cash, you can send that money directly to a charity. And so it's called a qualified charitable distribution or a QCD. And what that does is that RMD IRA income doesn't show up on your return. Um, and you don't get the deduction side of it, but on a net tax basis, you're in the same place. But if that gets big enough, and you can do up to, I believe, around $108,000 a year, so that can be a significant way that you can eliminate some of these phase outs. Another strategy is to donate appreciated investments. So if you have appreciated stock, you could donate that stock to a charity, maybe do it through a donor advised fund. And then in that instance, you're going to avoid paying the capital gains tax because you didn't sell it, and you get the full deduction for the donation. And so with that cash that you would have otherwise given to the charity, you can take that cash and rebuy the same stock. And now you have a higher tax basis and you've avoided that gain forever. We talked some about accelerated depreciation, and we can pull some levers to speed that up or slow that down and pinpoint exactly where we want to be. And then the last piece is, especially for small businesses that are cash basis, you can do some things to affect the timing of your income and deductions. Maybe you make some purchases at the end of the year, or maybe you slow down your invoicing for a couple weeks at the end of the year. You might be able to make some changes that can affect your income one way or the other.
Yeah. Those are all really good things because as you've laid out, Aaron, those phase outs matter even more so now than they ever have in the past. And so some of those cliffs even come into play, the marriage penalty that we previously discussed, and all of these strategies help lower your AGI, your taxable income, to where you can get benefit of some of those newer tax law changes. So that's really good. And then we do have some just other general planning ideas for reducing income taxes outside of just the phase out and things like that.
Yep. And some of these are ones that we've talked about, like using the donor advised fund to really push maybe multiple years of giving or tithing into 2025, where they'll be more efficient. You can also do similar things with your itemized deductions. So not only charitable deductions, but maybe state tax payments to be able to game the system a little bit and maximize your itemized versus your standard deductions. Um, we talked about making sure you are maxing out your retirement plans. And for small business owners, you may consider starting a retirement plan, particularly if you're self-employed. The plans can be very cost effective. And for companies that have employees, there are even some pretty nice retirement plan startup credits that can defray the cost for the first few years of operating that plan. Lastly, we'll mention a Roth conversion, which is where you take money from a regular IRA and move it into a Roth IRA. And essentially, what you're doing is you're prepaying the tax. So you have to pay the tax today on the value of that conversion. But once it's in the Roth IRA, it grows tax-free forever. And when you access that money in retirement, you don't pay taxes when it comes out. So if you're in a season where your income is particularly low, or maybe you've taken a lot of accelerated depreciation, doing a Roth conversion is something where you can prepay the tax at maybe a very low rate and save yourself having to pay tax at a higher rate in the future in retirement.
Yeah, I think definitely talking to an advisor before you do a Roth conversion to just confirm what you're trying to do is what you're actually doing. Because We've seen people that have just been in a pattern of doing Roth conversions over the past few years to kind of get money into different non-taxable or post-tax buckets. And doing a Roth conversion actually may put you into a higher tax bracket where you offset some of the tax benefit that we discussed earlier today. So if you are planning a Roth conversion, I would highly recommend speaking with an advisor to make sure that you're achieving what you're wanting to. All right,
I think
Rachel, we've
Yeah,
got
I
some other
think even
year-end
better
stuff.
with that is letting your financial advisor who may be handling your investments and your tax advisor talk together with you versus trying to relay that information as a third party so that nothing gets lost in translation, so that all people are fully educated on exactly what your goals are and exactly what your income level is before making those decisions.
Yeah, for sure. And it's always good when those two parties speak. So if you don't do anything else, what should we leave people with before year end, Rachel?
Yeah. Well, other things to remember around year end, Aaron, I'll let you take these just so I don't mess them up.
Yeah, just a few odds and ends. The fourth quarter estimated payments are due January 15th of 2026. If it would benefit you, this might be a good year to accelerate the state tax payment if it might be deductible in 2025 with the new $40,000 limit. If you have college costs, make sure that you are taking those out of the 529 account before the end of the year. One of the things that OBBBA did was to expand the type of costs. So some of the costs that people often overlook include room and board, and now there's some expanded ability to use K-12 costs, some homeschooling, or even credentialing costs like a CPA or a bar exam. Make sure you use up all your flexible spending accounts. And then the last point I would leave you with is that it's never been more important than it is now to look at tax projections because all of these phase outs and competing priorities, competing traps that you might fall into, the only way that you can really effectively plan around it is to look at a tax projection, in some cases, a multi-year tax projection, and that's probably where your advisor can come in to help you figure out how to prioritize all these ideas and suggestions and make sure that you're focused on the right ones.
Yeah, that's really good. And Aaron, the only thing I would add to this whole conversation is we have talked only about federal tax updates today. We haven't talked anything about state. And I know that you're in Colorado. We have people in Missouri, California, Texas. We're not touching on any of the state tax. That could be a completely, and it would be a completely different conversation.
Yep, it adds another wrinkle for sure.
I think just, yes, even more to highlight why it is important to work with a professional, even if you feel like your return is simple. So, depending on what your tax situation looks like this year with this new law, next year, that will be very important to make sure that you fully understand the impact to you as the taxpayer, and even if it's for a short amount of time, to make sure that you are doing the right things over the next 2 years, still we would recommend talking with a professional at minimum during that time. Some next steps. We appreciate if you have tracked with us the whole way through this webinar. We want to make sure, again, we have highlighted this because it is so important. Schedule a call with your tax professional to review your situation. If you are a client of ours, make sure you reach out to our team by December 12th. We just want to make sure that before the holidays get here, that we have met, that we have collected any information. Most of the time with our year-end tax projections, we need record of all income, of tax payments made. So there are some things that you may need to gather as far as documents and data for us if we don't already have it. So that's why December 12th is an important date that you contact our team. The QR code on the right will let you do that if you are not a client. And if you are a client, you can contact your team of three. You have their contact information. And then finally, if you missed the first two or you just want to go back and hear about especially the charitable individual contributions and how that was impacted by OBBA, we invite you to our YouTube channel. So it is linked here in the presentation, or you can go to YouTube and search at Dillon Business Advisors, and you will find all three of the webinars in this series that you can watch on your own time. So, Aaron, we appreciate you taking the time to share all of these updates, to share specifically how individuals will be impacted. Marcus, thank you too for sharing examples and just adding into what that means for business owners and individuals as well. Do you guys have anything to share before we go?
I would just say we've shared a lot, but we've only shared a few points out of the new tax law. There's so much more still to unpack. So as you mentioned, Rachel, would highly recommend speaking with your advisor, whether that's at DBA or if you have somebody else that's giving you, guidance on things like this. But thanks for leading the conversation. Aaron, final thoughts?
It's a complicated bill, and I hope that you'll reach out to us with any questions. We love to look at situations and find tax savings wherever we can.
Absolutely. All right. Well, happy holidays to everyone watching, Marcus and Aaron. I will talk to you guys later. And for that, we will end the webinar at this time.
Thanks so much.